Hi, Gary here. You remember singing along with Mitch, following that bouncing ball back in the early 60s? Sometimes I would get confused with that. I was a young kid at that time, watching that bouncing ball go across the screen with the chorus in the background singing and everything. Sometimes I think of that one. Once in a while we'll have someone come in that we just meet and we see a whole bunch of assets that you can tell were put in place over time, bouncing from one place to another because something was hot and then something else was hot and so forth and so on. And it really ends up being a really dysfunctional overall portfolio. So, what's really, really important here is to decide a couple of things. First is, which game are you in? Are you in the get rich game or the stay rich game? Now, for you who are successful investors, you're probably in the stay rich game. And that one fact alone will make a big difference as to how you structure your portfolio. Now, in the past 30 years I've been in this business, survey after survey say that you say, 4 to 5 of you, that wealth preservation is the number one most important concern. In other words, make sure you preserve what you got. You're going to be in the stay rich game. Well, what's it all about? Let's just break it down to 2 rules to make it really simple, super simple. First is an appropriate structure, and next is diversification. So when I mean appropriate structure, what do I mean by that? Well, what I mean is, let's say you need $150,000 to live, and maybe you got $50,000 coming in, from pension and Social Security. So you need $100,000 from your portfolio. Well, you need to have at least $100,000 sitting out there in cash or readily available cash, and then another 3 to 10 years worth that you can turn into cash somewhat rapidly over time. Why? Because we could have bad markets, both stock and bond markets, that take place in bad economies for extended period of times. We just went through one here recently in 2008, 2009. Took 3 or 4 years for all that recovery to take place, and you don't want to go and access the stocks you have out there when they're down low. Remember, you buy low and sell high. So you need to have those things in place. There's a lot more to structure than that, but I think you get the idea. The second part of it is diversification. What do I mean by that? Well, let's look at the stock market. Well, you've got domestic stocks, you've got foreign stocks, you've got large stocks, you've got small stocks. There's a combination of all of these things out there, and you want to be diversified because you never know which area the market's going to do what. Yeah, look at this year. Beginning of the year, we saw a sell-off in small mid-cap domestic stocks, and all of a sudden we saw emerging markets come back after being really hammered last year. And then we went from large value stocks to now large growth stocks. This has all happened in the first 8 months of this year. Well, if you tried to follow that bouncing ball, boy, you could really be in bad shape. So the name of the game is to diversify, get that overall rate of return, and make sure you're not trying to run and chase returns. That just ends up in negative results. It's very important not to do that. So be careful. 2 rules: structure and diversification. Now, I've got a couple events coming up on September 17th and 18th. Either one your choice. If you're looking at domiciling in Florida, please check the information out here. Sign up with the 888 number, and we'd love to see you there. And next, by popular demand, coming back is our technology open house at night, and it's on Thursday, October 9th. Again, mark your calendars. Please come by. We'll have lots of different areas that you've asked us about to help you deal with technology, simplifying things, really take control over that in your life as things change and out there and move along. So until next time, enjoy.